Hey everyone, Dave Keller here with Market Misbehavior, and welcome to the first episode of the new Market Misbehavior podcast. Super excited to bring some interviews here to my YouTube channel. I've enjoyed so much being able to interview some top market practitioners, talk to them about their routines and their processes, their market outlooks, how they are talking to their own clients, and how they are putting money to work in their own portfolios. I've enjoyed so much over the course of my career being able to talk to some really successful investors, and I look forward to bringing some of those great conversations to you here through the Market Misbehavior podcast. Today we're talking with Mark Newton. Mark is a CMT charter holder. He's the head of technical research at Fundstrat Global Advisors, working with Tom Lee in the New York area to help institutional investors, hedge fund traders, and also now retail investors through their fsinsight.com website. Mark's had a very successful career on Wall Street. He's worked on the buy side at hedge funds like Diamondback. He's worked on the sell side at places like Morgan Stanley, working in their technical research department. He also is a former floor trader at the CBOE in Chicago. So he has a great wealth of expertise, but really does a really fantastic job, I think, of balancing the technical inputs with other investment disciplines. In my conversation with Mark here, which you'll hear momentarily, we talked about the incredible rally in China, the sustainability of that rally and what that might suggest, the strength in precious metals like gold and silver, and a potential mid-October cycle peak in those markets. The new leadership or renewed strength that we've seen in the technology sector, and how the leadership themes have really evolved through the course of 2024 on the equity side. Talk about how to play the election season between now and early November, and what different outcomes to the presidential election could mean for your portfolio. We talked about the benefits of looking at equal weighted indexes and ETFs, and he had some really great points about how to minimize the mega cap impact of some of those largest names, which really have an oversized influence on our benchmarks, and how to focus on equal weighted measures of performance as a more truer representation of the performance of different areas of the market. Folks, here's my conversation with Mark Newton of Fundstrat Global Advisors. Please enjoy. Hey everyone, I'm here with Mark Newton, CMT from Fundstrat Global Advisors. Mark, good to see you again. How are you these days? Okay.
Thanks, Dave. Everything's great. Thanks for having me on. I appreciate it.
So a lot to talk about. We were talking about before we sort of got the recording started here. Just our cup runneth over with potential catalysts, potential events, and market forces to discuss and debate. Give us sort of the high level review. I mean, the S&P, fresh off of a new all time high above 5750 just in the last week here as we're recording in early October. Where are you at in terms of the trajectory of these markets and what to expect here in the weeks going forward?
Thanks. So I'm still very constructive on the U.S. stock market this year. I think we've seen a very impressive recovery in breadth since the early part of August. It's been very helpful to the market. As you mentioned, S&P is now back at new all-time highs, as well as the Dow. I do believe that NASDAQ will, in fact, follow suit. So, I look at sentiment as being sort of neutral, not overly exuberant or even complacent, which makes sense given that this is an election year and there's a lot of divisiveness and polarity. And obviously the escalation of geopolitical risk overseas is also, a very big deal, as well as our own, issues with various hurricanes, in different areas of the Southeast, which is, unfortunate. And we pray for all those people as well. So look, it's a tough time. There's a lot that can get us worried, but when I look at, just the basics of looking at technical structure, momentum, breadth, seasonality in election years, typically October is a worse year than September, but I just haven't seen sufficient proof to think that we are entering any sort of drawdown as of yet. And a lot of that just has to do with technology having snapped back in resilient fashion. Cyclically, the cycle should extend into next year before peaking the broader intermediate term cycle for the S&P. So, the combination of things that I look at is still very constructive. And so, I think, we are in election year, and eventually we probably do get a little bit of a pullback, but I would say that I'm still pretty bullish and do not think that our recent drawdown is really the start of anything just yet. So I think S&P probably gets to over 5,800, and then maybe you should do some backing and filling. But there's a lot of reasons to be optimistic at a time when many aren't.
What, you mentioned obviously a number of sort of macro drivers, right? I mean, and we didn't really mention, the Fed, obviously, with a rate cut cycle, geopolitical risk, events in the Middle East, and a very highly contested election. And I mean, further down the list, but still very important, hurricane that just ravaged the eastern half of the country, dock workers on strike in the Northeast and on the eastern seaboard. How do you, I mean, your experience obviously as a technical analyst, but obviously working with a lot of investors that have a lot of different inputs. How do you balance what you're seeing on the charts with all these other things that obviously have the ability to influence the markets in a pretty meaningful way? How do you balance those messages?
I balance them simply by letting investors know that as a technical analyst, that my experience has told me that all these exogenous factors largely have very little impact on the stock market, and as much as all these little pieces of information are now within our fingertips, far easier. We all have access to information at a quicker pace than ever before in history, and so you see a lot of really negative headlines that are put out there to get us to click on them. But honestly, the big factors in my view are what's happening with China, which I think is a very important positive in the short run. There are certainly some tailwinds with regards to trying to provide a sugar high to their own markets. Whether that is a long-term fix for their own fundamental issues, I think it's probably dubious at best, and probably does not work. But I think it is, at least the perception of China coming back is a very big positive. So I think that's the first thing. The second is that markets have largely rallied on the expectation that bad economic news would lead to rates pulling back sharply, and that in tune would be bullish for the stock market as the Fed's rate cuts are brought forward. And that has happened. Now we're at a time when potentially that could be changing. The Fed is no longer emphasizing inflation. It's more worried about the labor market. And so, bad news at this point, I think probably would be bad news, and evidence of economic resilience, which we've seen with regards to GDP and honestly jobs, is still okay. So the market's sort of in a sweet spot where we do see a little bit of evidence of the economy weakening on the fringes, but it's not sufficient to really derail the stock market at a time when earnings have been pretty good. There's a heightened level of anxiety this year, but a lot of sector rotation. We can talk about that a little bit too, but largely tech has managed to hang in there. It's been obviously choppy since July, but other sectors have managed to snap back, and that's been a very positive force for the market.
When you think about sector leadership, and you hit on a number of really interesting things there, Mark. When you think about sector leadership, right? Q1, I think of this year, sort of the Magnificent Seven, right? The growth stocks leading. Q2 is a little more value, things like industrials, materials. Q3 all of a sudden got to defensive sectors, right? In July and August, with utilities, REITs doing well. What's Q4 feel? I mean, now all of a sudden we see retail start to improve, technology, getting a bit of a bid. What do you see as sort of the emerging leadership now going into year end?
I still love industrials. That sector on a relative basis to the S&P in equal-weighted terms has just made new all-time highs. And that, of course, moved to almost new 2-decade highs in equal-weighted terms. I always try to strip out the larger components of most of these ETFs. It just makes it very difficult when they're camouflaged to get a real picture. And I always don't use SPY as a denominator, because that's largely just comparing a sector versus technology, given the influence of Apple and NVIDIA and everything else. So I try to look at everything on an equal-weighted basis. It helps to keep things a little clearer to me. So I love industrials. Honestly, financials is still an overweight for me. I do sense that some of these banks haven't worked as well of late. Some of the regional banks have been a mixed picture, but you're still seeing good strength in insurance stocks and parts of the credit card companies and exchanges. The larger areas like the Berkshire Hathaways and the JP Morgans still look fine. So I think financials for me, industrials, I'd also have to say just technology has not been shaken out enough to really cause sufficient deterioration that I would avoid it. And so you look at charts like IGV, for example, the software ETF, which is about to break out of literally a multi-month, multi-year type larger base. And very interesting to me, very, very important and positive strength out of stocks like Salesforce and Oracle, which are two big leaders within that software space. But also you pull up like hardware stocks like Apple, which have formed, bullish triangle patterns, and obviously one of the most, if not the most important stock within the entire S&P. So I find it difficult to be too negative when some of the leading parts within the indices are still acting quite nicely. That being said, I'm not as fond of energy here. I think this little bounce on the geopolitical uptick proved short-lived. I think that, in relative terms, if you look at eco-rated energy, you have broken to multi-year lows versus eco-rated S&P. That's a problem. We heard that Saudi Arabia is not happy with the degree of countries like Iraq and Kazakhstan really continuing to pump out very high levels of crude. The supply, not only in the U.S., regardless of who makes it in November, U.S. oil production is certainly on the rise, and under a Trump presidency, likely would go up even higher. So I think that the supply part of the equation is very high. The demand is a big question mark, and that supply-demand imbalance favors selling energy, in my view. And healthcare also has been a little bit of a mixed picture. So healthcare and energy are really ones to be a little bit more selective. Discretionary, I have not bought into this little move. I do suspect that it can continue in the short run. But, again, I don't necessarily love watching, looking at Tesla and Amazon as being discretionary. On an eco-rated basis, the sector has struggled for years. And so it is important to be selective there. I do suspect that China is helping the casinos come back. That's been a very positive force within discretionary. But that's a mixed picture. It could have to do with the consumer being stretched and really not able to respond. So I think that's more of a 2025, 2026 issue, not really this year.
Yeah.
This year, we're looking at, percentage of stocks within 20% of 52-week highs is now at 88%. That's a phenomenal level where, much different picture from 2021, where things were sliding the entire year and gave us a big warning about going into a bear market. This is the opposite, where many different parts of the picture are working well at a time when everybody's wondering, oh, when is this market going to fall apart? We're in October now, we're in September, and there are reasons why it's not, and it's being held up by a lot of stocks that are truly acting well.
You've hit on so many great points there, Mark, to be honest with you. I love you. You talked about China, obviously, which, it was sort of an area of the global markets that I think so many investors had just sort of written off for the longest time, and for good reason, because the performance was not really there. All of a sudden, we've had a, sort of an exponential rise in a short period of time. Yeah. From a technical perspective, I know a lot of investors are sort of hit by the FOMO of what they see on a chart like this that improves so quickly. What do you do in this sort of environment? I mean, generally speaking, and then again with China, I mean, is this the type of move that you try to buy into? Do you wait for weakness? Like, how do you try to build a position in something like this that just feels like it's going vertical?
A lot of great questions. I'll start from the beginning. Much depends on your time frame and your risk tolerance as to how you approach something like FXI or KWEB as two of the leading ETFs for China. This daily picture shows you a reason why you likely still want to stay involved, and that it has a number of what they call gaps in this move, runaway gaps that are occurring with very high volume that we haven't seen in some time. So yes, FXI is up nearly 40% in 3 weeks. It bottomed on 9/10, September the 10th. And since then, it's just been a runaway freight train. So in the short run, I honestly still expect this move to continue a bit longer. My methods do not show it having shown any sort of reversal, and the volume is still very much there. But I suspect that as we get into the back part of October, we are going to see some consolidation there, likely into year end. I think FXI probably gets to 37.5. I would look at the 50% retracement of the entire sell-off since 2021. If you pull up a weekly chart on that or monthly, it helps to put things into perspective, and that even going back since 07, there's a lengthy trend line that undercuts the lows from 07 into, and you draw the trend line from that lowest low and connect all those former lows. That will get you up to an area where we probably see FXI hit a brick wall, and I think that's going to be up near 37.5, because that intersects the 50% retracement area. that's how I would look at it on an intermediate term basis. Right now, it's still very much, an area that I would participate in, but obviously the risk reward has gone a little bit subpar, to say the least, just given the extent of the move. But as the traditional saying goes, sometimes when the horse runs out of the barn, you got to go catch it because it might not come back. And I think that this thing certainly is apropos for how I look at China. We've had a number of false starts, and I myself have attempted to get involved. I've talked to hedge funds about this, and they said, okay, now's the time. And then it's like, okay, well, I guess we're wrong again. And how about this time? And no, we're wrong again. And this time, people take profits so quickly on some of these moves that you're really not involved at a time when you need to be. So the trend is your friend. The trend certainly is up in the short run. Intermediate term basis, I give it another 10%, and I think we probably do stall out.
Another area of the market we haven't talked about yet, but with a ridiculously exponential rise, arguably, is precious metals, particularly gold. Yeah. I mean, gold's continued to sort of pound to new all-time highs, and I think a lot of people still sort of think of gold as sort of the safe haven. So you don't think of gold rallying at a time when equities are, but we're certainly seeing that. What's your take on gold here? Is this still an area of the market that you see as showing further strength? And why or why not?
I don't think we've seen hardly any technical damage in trends to suggest that gold would not be still something to own. I do have concerns with the level that it's risen in the last few days. My own cycle studies for gold suggest that in the mid to late part of October, we probably do make a peak in gold. This is still sort of a seasonal time of strength, but I don't think it's going to run forever. I would encourage investors to take a look at what's happening with interest rates. And often when you do see a change of trend in the 10-year, that can almost inversely correlate with when gold also will make a top or a bottom. And we've seen that in recent years. So, in recent months, we've seen both the dollar and also the 10-year treasury both head straight to the downside, lower. That's been a time of very good strength for precious metals. We also know, of course, that they tend to do well during rate cuts, which we've just started, and that if the Fed is going to cut 150 basis points between now and next summer, that should bode well for the metals. But it looks like they've really almost, front run this move. They've moved ahead of the Fed cutting, and it's been an interesting year because gold has not really observed this traditional relationship with real rates, which typically, as real rates fall, gold spikes, and real rates have been sort of choppier, whereas gold has still just moved parabolically. My bottom line is that I think we probably have another few weeks of gains. I'm not extraordinarily excited to buy it above 2,700. I think that I would probably, similar to China, I have to be there given the trend, but I would await evidence of pullbacks. I think silver, to me, makes a little more sense given that China is reawakening and their need for the base metals that really drive silver and really what silver is used for. Silver looks interesting to me. I still have to own gold. I own them both, but I think that as a trade, we're probably running on fumes, and just given some of the positioning and the sentiment, there's going to be times to buy weakness, I think, into fourth quarter, probably before December. December historically has been a great month. So I'd love to buy, own gold. I probably, from a trading perspective, tactically, I would sell it in a couple of weeks and look to buy it back beginning in December on any sort of weakness, and look to really continue to hold it as the intermediate term trend is still positive.
Yeah, really interesting combination of the trend we're seeing and also the cycles, right? And where gold tends to have some seasonal weakness. We mentioned the election season a couple times. We've got about another month here in the U.S. of a very contested election season until we hopefully get some sort of closure there. But with two potentially very different outcomes depending on who takes control. What do you do? Is there anything that you do now, to prepare a portfolio, or any moves you make now in anticipation of what's happening for you? Is it more of a follow the evidence, follow the themes, and then see what emerges after that election? I mean, what do you do between now and an election day?
Look, I don't know if we can put much faith in the polls anymore, but the polls right now would suggest things are very, very tight. And that being said, there's no reason to try to make a big bet based on one way or the other. I think that history has shown us that no matter, what side is in control, that markets, generally can thrive during both Republican and Democratic, presidencies, and that it's really difficult to say, even though some might personally believe, and I personally believe that, companies tend to benefit obviously under deregulation and cutting taxes versus hiking taxes and this and that. But, in the bigger scheme of things, for me, the bigger issue is the balance of power in Congress. The congressional races will mean a lot more than the presidential race. If we see the Senate flip to Republican or see potentially the House flip and have a divided House, that probably is going to be more beneficial than really any sort of lopsided power and extreme that we see in either direction. The one thing I would point out is that, under a potential Harris leadership, she obviously favors electrification, solar energy, alternative energy. Those stocks certainly thrived after her debate performance the last time. So that would be an area that I think probably would have merit. As I mentioned earlier, I don't think either party is probably good for energy, only because the current administration wants to see inflation continue to fall. We're keeping U.S. supply very high, and under a Trump administration, he'll look to assert complete U.S. dominance under oil infrastructure, and we'll see that likely U.S. Supply goes up so far to make the U.S. self-reliant again that, we probably see oil continue down over the next year. So energy would be my bearish pick. As a bullish pick, healthcare is a little bit of a mixed bag, I think. You did see evidence of, Medicare Advantage stocks going higher temporarily, under Trump, as to whether the FDA and Lena Khan, with all the mergers and acquisition type pressure, whether that is resolved or not is a big question mark. I think tech does well. It's more about what the Fed is doing than really a presidential stance. That's also important. And on the eve, or as we've started these rate cuts now, industrials and tech should thrive. If the economy starts to weaken, it's very well could favor large cap growth. Yet again, these are companies that have changed all our lives for the better. They certainly should continue to. On the small cap side, it's just been a difficult trade. 40% of these companies don't make money. And I think I do suspect that small caps rally likely into next spring, summer. But I'm much more on the side of owning large cap growth for the indefinite future, and think that is likely, the area that does well.
It's interesting. I mean, all through the course of 2024, I feel like there have been a number of times where it felt like the return of small caps and being ready for that, but large cap growth has continued to dominate. I mean, year to date, it's certainly been the place to be. Just to finish off here, I mean, as we're looking at the chart of the S&P 500, Mark, what would you see? I guess what would be that one chart you would keep in mind besides the S&P to get a read on what's going to be happening here over the next couple of weeks? It could be breadth, could be some other asset class like interest rates or something. What would be that go-to market tell that you think is important for investors to keep in mind here?
I don't know that you could list one chart, Dave. I mean, I probably could give you a list of 10. That's the way I like to really look. I like to put probability in my favor. I think you have to keep an eye on breadth very carefully. And right now, breadth is actually doing very well. So there are a number of ways to do that. You can look at advanced decline data or summation index from McClellan, or as I like to do, like percentage of stocks within 20% of 52-week highs. Historically, when that starts to roll over sharply, that's not a great time for the market in the months to come thereafter. So that will almost always give you your warning sign of a market that could turn, I think, in advance. Fewer stocks hitting new highs, which you can't see when you just look at the indices. You have to look under the hood at what stocks are doing well. So that's something that I would encourage investors to look at. Also, just start to make use of equal weighted ETFs in your relative studies, as opposed to looking at the cap weighted or just looking at the S&P, which is largely tech. Many times in the last couple of months, we've seen tech floundering, but yet the broader market's holding up, and the market ends up resolving itself to the upside because many different parts of the market are still working quite well. Sentiment also much more important than news. Identify ways of looking at individual and also institutional sentiment. Find what's in extremes, and that's probably one of the best ways you can time markets along with cycles and traditional just technical structure than almost anything. So tough to look at one market. I say you look at the RSP. That's been phenomenal. That's more of obviously the equal-weighted S&P by Invesco, that ETF. Many people look at SPW, of course, as just the equal-weighted S&P. But that's as the market gets heavier and heavier with its percentages with all these tech stocks. You want to have a way of identifying the market, so to speak, and so as not to cloud your judgment.
You mentioned a number of times, Mark, the equal-weighted ETFs, equal-weighted indexes. I think that's a brilliant comment there. And I mean, so many of the sector ETFs, as an example, super top-heavy. 2 or 3 stocks make up probably half of the weight in a lot of those. So worth noting for sure. Mark, this was awesome. I really appreciate you coming on the podcast here. Where can people find out more about you and your work and follow what you're doing?
So you can either go to fundstrat.com, Fundstrat. That's the company that I joined 3 years ago with Tom Lee. FS Insight is our retail branch of Fundstrat. And so I do publish every weekday. I have a market newsletter I put out, as well as a 5 to 7 minute video every single weekday. On Twitter, X, I do post daily, but it's not as much actionable content. So I would encourage you to actually try to find ways of reading my note. What I'll do is that if anybody that wants to join based on that's here today, happy to extend a 2-week free pass. You can check out all our work and what we're doing. Obviously, Tom Lee is the mastermind and looking at things fundamentally and from a macro perspective. But we have a policy team. We have a digital assets team. We're doing a lot of great things. And so Mark Newton CMT is my Twitter handle, so to speak. And, I'd encourage you to, that's about, you can certainly find me in one of those places, hopefully.
That's great. And fsinsight.com, I think, as you mentioned, is the retail product that you guys offer with you and Tom Lee and others. I think do a fantastic job with it. Mark Newton, thanks so much again for joining. Have a great day. All right.
Thanks, Dave. Happy October, everybody.
So that's my conversation with Mark Newton of Fundstrat Global Advisors. Again, you can learn more information about Mark and Tom Lee and others, their work for individual investors at fsinsight.com. Really appreciated Mark's thoughts on equal-weighted measures of performance. We use a lot of equal-weighted indexes in our own work. As a matter of fact, our newer Dow theory is built all on equal-weighted indexes for the S&P and for the NASDAQ 100. I think his comments on that were really well described. The other thing I would say is to his point of ignoring, or I guess thinking less about the potential impact of macro events. I think so many of us are really, seeing our anxiety levels rise, thinking about events in the Middle East, the hurricane that just ravaged the eastern half of the country, potential shutdowns because of the dock workers strike on the eastern seaboard, events in the Middle East, the election season, Fed lowering rates, all that. I mean, so many potential drivers. At the end of the day, one of the true benefits of charting and technical analysis is to cut through all that noise and focus on what the charts are actually telling us. Thanks so much for watching the episode. I appreciate you so much sharing this interview anywhere where you can, and wherever you're watching this or streaming this. If you could like it and drop a comment for me, I'd really appreciate it. Who else should I interview on the Market Misbehavior podcast? Please let me know. For Market Misbehavior, I'm Dave Keller, and remember, it's always a good time to own good charts. Have a great one.